Hello, everyone. My name is Steve Kowal from MSCI, principal sponsors of the PIMFA ESG Academy for Wealth Managers. Taking ESG factors and preferences into account when designing client portfolios is rapidly mainstreaming to the extent that some regulators are now mandating it as part of the advice-giving process. This presents a new series of challenges for private wealth advisors with respect to assessing the unique needs of clients, evaluating appropriate investments and implementing them in portfolios, and demonstrating to clients how those choices have resulted in a positive ESG outcome. To help you navigate these subjects, we are pleased to bring you a view from someone in the industry that has experience in the practicalities of providing ESG-oriented investment solutions to investors. And with that, I welcome Amy Lazenby, Managing Director at Close Brothers Asset Management. Amy is a managing director at Close Brothers. She heads up the discretionary management service and founded and launched the socially responsible investing service just around 6 years ago. Amy sits on the multi-asset class committee and is a key member of the investment team responsible for deciding Close Brothers' house asset allocation and investment decisions. Prior to joining Close, Amy was a founding partner of a private client discretionary investment management business, which she ran for 10 years before selling her 45% share to her co-founder. Amy is a chartered wealth manager and fellow of the Securities Institute. She sits on the editorial panel of the Securities and Investment Review for 9 years, and for 9 years sat on the investment committee for the Wealth Management Forum, organizing bi-monthly events. Welcome, Amy.
Hello, very nice to see you.
Great. So, Amy, maybe you at 6 years having run SRI service, you're almost an old hand at this. It seems in the lifespan of ESG investing as we know it today. What kind of things have you seen, changes have you noticed in the past 6 years in terms of either adoption, uptake, growth, people's responses?
There's been a tremendous change over the last 6 years. And if we can go back even further and look back when I sort of started my investment career 20 years ago, anything that had a negative exclusion in the portfolio really made a very big difference to the way the portfolio is constructed and to eventual returns. Partly because investing was predominantly about, for a UK investor, investing in the UK market. And as we know, the UK index is very heavily skewed to certain sectors. So anybody that had any ideals or morals that they would like to abide to within their investment portfolios, perhaps excluding the big oil majors, mining companies, tobacco companies, had experienced a very different investment journey from those who didn't want to provide exclusions. But this all really changed with the advent and the launching of the United Nations Sustainable Development Goals, December 2015, because they provided a positive framework for aligning your investment portfolio with your outlook on life and with sustainability and with all sorts of positive ideals, which not only creates better engagement between the individual and their portfolio, but it's a much more positive framework in general. So having run ethical portfolios for many years for those clients, it was never very mainstream as part of the business because it was always deemed a little bit on the side, but the positive framework has allowed the mainstream to engage with this. And it was created by countries for countries, but it has been adopted by businesses. And governments globally have mandated regulations and put trillions of dollars behind achieving these goals over a long period of time. And funnily enough, this has meant that the corporates that are backing these goals or aligning themselves with these goals are doing very well. And that has in turn helped investment returns. So it has been very different. But even since the United Nations goals have been launched, there was some skepticism at first. And it wasn't very many years ago when I was speaking to companies and fund managers asking what their ESG policies were, and I got blank looks. But now everybody has one and they go back 15 years. So there's definitely some rewriting of history, but all in all, it's been extremely positive, and it probably won't be long before this is absolutely the mainstream way of investing, because all it is doing is identifying very positive ways of behavior and ideals around sustainability.
So there is a process here, and we'll go through that. So let's start off maybe with the beginning. So at the first part of the process would seemingly be assessing the needs of a client. So could you talk to us a little bit about how you go about that, how you frame the conversation with the client in terms of trying to assess what they might be looking for from an SRI or ESG context?
As part of our Know Your Client due diligence, we will always try and understand if our clients have an interest in their portfolios over and above the financial returns. And the answer today is overwhelmingly yes, although to varying degrees. Some clients are very specific about what they like and dislike, while other clients simply want to ensure we're investing their money prudently in businesses that behave well and that hopefully aren't going to get embroiled in a scandal, which is both bad from a reputational perspective and a financial perspective. I think one of my most interesting portfolios is a portfolio designed to have a positive impact on the environment. But while that isn't the norm, increasingly clients don't wish to invest in some of the traditional sin sectors. And I think this is partly because they believe it isn't right to support such industries, and perhaps partly because they believe they'll end up being invested in, stranded assets. So it's much better to look to the future and find opportunities for future growth. So it tends to be a broader conversation with the client about their interests, and you very quickly get an understanding of what they'd really like to see from their portfolio. Conversations that might have been popular 20 years ago, centering around things like animal testing, are no longer core to debates today, in my experience, perhaps because the industry's listened and responded to consumer concerns, but also in part because the current focus for most people, and this is something supported by governments, is the energy transition and decarbonisation. So conversations are changing, but it's quite easy when you just start engaging with the client at the outset to try and to understand what it is that's meaningful to them, and then therefore that can be included in their portfolio construction.
If we can dig just a hair deeper into that. So in my experience, you can have either a reactive discussion or a proactive discussion. And what I mean by that is a reactive would be, dear client, do you care about ESG? And then it's either yes, no, and wherever that leads. A proactive would be, if I could show you potentially how we could adjust your portfolio to take certain ESG aspects into account and still deliver Y, is that something that you would be interested in discussing? So you're by advice leading the client to the discussion, as opposed to just throwing it out there and hoping they come back with something or have some knowledge or some feeling. Where do you come down in there?
I slightly come down on the latter because we run, I'm in a team running the socially responsible investment portfolios, and performance has been very strong. So that actually helps the conversation. But that is my belief. And I think very quickly, if you talk to me, you'll understand that that's something that I'm interested in. So when I'm talking to my clients, I do often engage and ask them if they're interested. And I've never had a negative response to that kind of positive engagement with a client. But it isn't necessarily the way that everybody works. And I think there's room for all different approaches.
So when you're talking about that aspect with clients, can you give us maybe a sense with your experience of the breadth? So I guess on the one end of the scale would be your more classic exclusions. I don't want landmines. I don't want whatever tobacco in my portfolios. Can you tell us what the variance you have encountered in terms of, you mentioned someone who wanted something impact, which would be almost the other end of that scale. Can you, again, take us a little bit through that spectrum that you've experienced?
So those individuals who are wanting pure positive impact are very few and far between at the moment. And I think it is a very different style of investing. And because we're still on a journey, I mean, having moved from what I might refer to as traditional old-fashioned pure ethical exclusions to a more positive journey towards trying to identify companies that have a positive impact. I think it'll take time because the data is increasingly becoming better from providers such as MSCI and other third-party providers with whom we partner to get our data feeds. But it's evolving all the time. So that is definitely an extreme end at one side. Some clients do say they don't want to invest in certain sectors, but actually the general conversation today seems to be framed around a much more positive way of thinking. I want to look at some more interesting businesses that are meeting the challenges that we're facing. What ideas are you finding? And that naturally leads you into a portfolio that is more sustainable, more responsible in its outlook, considers all the environmental, social, and governance factors that we're discussing today. Some charities specifically like to have certain exclusions to align with the work that they're doing on a charitable basis. But again, there's nothing that has been a surprise. When it's been mentioned in a meeting, they're all very traditional: no arms or no alcohol or no tobacco. And actually, in a very global investment world that we live in today, when you exclude these businesses from the entire investable universe, it still leaves you with a tremendous amount of companies for potential investment. So I don't think there can be any excuse for underperforming when you take into account these preferences that clients like to impose, or when we like to suggest a sort of socially responsible portfolio, because a portfolio of 60 companies, and there are many thousands that are available for investment today.
So, Amy, let's turn to the evaluation of investments. So you talked about the emergence of data, et cetera. How then do you go to translate what the client's assessed needs are and then finding the investments that fit the brief, if you will?
Absolutely. Well, ESG risk factors are an integral part of our investment philosophy and investment approach. And the integration of these factors is laid down in our investment process and our responsible investment policy, and is applicable at a firm-wide level today. This has been introduced over the last few years. And the reason that we have an ESG philosophy is that we strongly believe that companies which respect their employees and their customers and the environment in which they operate are much more likely to thrive, and therefore they're better positioned to generate superior returns and value for their stakeholders. And it's worth giving that background because we have a team of analysts in-house, and because this is our general philosophy and belief, the analyst team incorporate ESG factors in all their primary research. So even if a client doesn't wish to have a ESG sustainable, responsible portfolio, the work will have been done in the background regardless, because it's just another factor in assessing whether a company is suitable to invest in. We look at financial metrics, we look at ESG metrics. And even if someone wished to invest in a company with a poor ESG score, they could do so, but they would do that with the knowledge that there was a inherent risk there, just like we might choose to invest in a very expensive stock or a very cheap stock that might be a value trap. So this work goes on behind the scenes in all our portfolio construction, regardless of the client's wishes, because it's just an important part of portfolio construction today in our view. Material ESG factors such as human rights and risks due to climate change tend to be discussed very widely, but we also partner with external providers, as I've mentioned. The ESG data we get from MSCI. We work with ISS Ethics to get detail on controversy reports so that we can have a better understanding about the human rights abuses and potential environmental damage a company may be causing. And we use MSCI business involvement screening as well. So we have a comprehensive set of data from third-party providers factors that provides additional information and support for our analysts to filter and for the investment managers to then incorporate in their investment decision making.
And is it a pure weighting in terms of, you assess the financials and give it a weight, and then there's the ESG, or depends on what the ESG potential controversy or issue is that gives it a higher or lower weight in your assessment?
No, I think it's not as clinical as that, because there are a lot of investment managers at Close Brothers and a lot of different client preferences and needs. And it's up to the investment manager to decide what is most appropriate. And as long as they're investing in companies armed with all information about their ESG scores, about their involvement in practices that may not be deemed appropriate for all clients, and about the financial metrics, they use their knowledge about their client to assess whether that is appropriate. Within our socially responsible investment portfolios, it is quite different. It is a much stricter screening process.
Climate, obviously climate is front and center. Net zero initiatives coming out every 10 seconds from somebody new. Do you separate or view climate distinctly from other ES or G criteria? How do you view and implement climate, if you do?
We don't implement it separately yet, other than for a couple of clients who have this positive leaning portfolios towards sort of environmental change and benefit. But it is something that absolutely will be being implemented in short order. I think the thing that we're lacking at the moment is just the ability. The change is happening so quickly that we lack the ability to monitor it all and implement it, straight away. So we have a very good idea what a portfolio might look like that has a focus on carbon neutrality and improving the environment. I don't know which angle you want to look at, the change that is happening. But we don't have access to a lot of the data that we'd like. I think there's still a lack of uniformity in the way companies report data, for example, from the carbon emissions. And so until there's a little bit better clarity from the data that we can get, it's very difficult to put a formal process in place to run such portfolios. But absolutely, that's something that's coming. But we would include a lot of those type of businesses in our socially responsible portfolios in any case, because this is where the growth is coming. They have the regulatory tailwinds, financial tailwinds, and it seems a no-brainer.
So now you have done the assessment, you've evaluated the investments, you've kind of done the implementation. Then comes the whole process of, now how do you report back to clients? So how do you demonstrate to the clients that they're, other than the exclusion, which I gather is easy to demonstrate, but in terms of this portfolio is doing what we said it would do from an ESG or socially responsible perspective?
So we have created an impact model tool, which helps share with clients more granular detail about the impact they're having with their investments, and it helps engage with them further. And the model shows the impact exposure mapped across 4 impact and investment themes: social empowerment, environmental protection, health, and economic advancement. And each of those 4 themes has within them one of the 17 United Nations Sustainable Development Goals. So the model that we use is based on the UN goals, which, as I've mentioned, are a call to action to promote prosperity and sustainability. But beneath those goals, we use 70 industry-specific themes to break them down to a more granular level of detail, and our analysts input into the model each of these industry-specific themes that a company's operations are exposed to. The model then calculates the total exposure to the global goals and produces an impact exposure score for each company. So we can also calculate the impact exposure at a portfolio level once we've had this for the equities. So when we're talking to clients, we communicate the impact with them through a graphic that shows the 4 impact and investment themes. Which companies are most impactful to that specific theme are listed there, but the percentage exposure to each of those themes takes into account companies which might have multiple exposures across different goals.
Terrific.
Ideally, what we'd like to do is to align, to present this information by percentage of revenue generated, but that data is not yet available.
Yeah. Which brings us to kind of the last question I want to ask, and that's what's missing? What are the challenges that you face in trying to do what you do? What are the gaps? Where do you think improvements can be made that would help better enable people like yourself to do your job?
Well, at first, I must say that over the last 5-6 years, the information has come through much more quickly. It has become much more detailed, and it is much more thorough. I think it is still a journey to improve. So consistency of data is really important to help us create a consistency of communication to our clients. I think the actual portfolios are great, and we've got the ability now to construct some of these portfolios, but communicating the impact can be improved further. We talked a little bit earlier about the carbon, the energy transition. I think data still needs to be improved there, but again, this is another area that has come through slightly more recently, and it has come with a force and isn't going away. So I'm sure that everyone is working very hard behind the scenes to get increasingly better data on these factors to enable better portfolio construction and better information, therefore, to be given to clients at the end. I think in terms of one of the challenges that clients face, perhaps, is if they are choosing a product off the shelf, they have to be very careful about the name of the product, because they might assume it meets their vision of ESG, but the nomenclature is still quite confused in the industry, although it is improving all the time. And an ESG fund can include a lot of the sin sectors. Similarly, a sustainable fund might also be able to include them, because everybody's view of what is sustainable is still different. So I think one of the warnings that needs to be put out is that the naming of the funds might not necessarily represent accurately the client's vision of what they'd like to invest in. So that is something that has to be looked at quite carefully.
All right, with that, I thank you very much, Amy. That was very informative. I'm sure our viewers will find it so. We thank you for your time and participation, and thanks to all of our viewers who have taken the time to listen to us today. Have a good day.